Okay, well, that's of course the big headlines that we are tracking for you on ET Now all evening. But first up, let's welcome now on the show Kartik Jhaveri. He is the founder and director of Transcend Consulting. Kartik, thank you so much for joining us today on ET Now. You know, when we usually talk about retirement, more often than not, and especially for the ones who are not yet retired, the idea is that, okay, I want to invest, or I want to save for my retirement, I'm contributing to my retirement nest egg. So they look at it as an objective. But what many fail to realize is that even after retirement, there is a lot of financial planning involved, if not more. So, why do you think it's even more important to continue with the financial planning process post-retirement?
The fundamental reason why we need to continue with financial planning, and more so, like you pointed out, Mubina, post-retirement, because the day you retire, your entire nest egg or your entire corpus or capital, whatever you want to call it, you're not going to finish it off. And you see, you have many, many years after your retirement. Life expectancy these days in India for anybody, we take it as about 80 to 85, which means there are a lot many years. It's just 2 decades of life left, and that's a lot of life. And not to mention that you will travel, you will have medical expenses, you might have, grandchildren expenses, if you may like. You might have a lot of charitable and gifting expenses also. So now you have different set of needs, but you need to have buckets all again made for them, and then a little bit of money put into each one of them so that you're able to fulfill those requirements as you sort of move along. And what a lot of people run into like a little bit of a problem is you underestimate the impact of inflation. So, you might think that the television 10 years back cost you the same rate it's costing today, but your life is not going to cost the same way. You will have far more expenditure as you sort of move along the years. So I think that's a huge mistake that a lot of people do in terms of calculation and even understanding the kind of impact that inflation will have. So yes, there's a lot of work to do. You are not going to finish money in an instant, and you need to have different strategies even for those 20 or 25 years. It's a long time, and which is why there needs to be a very, very structured strategy around that.
In fact, I was reading this report by PGIM India a couple of months ago, actually now, but they did have this very starking, survey which said that Indians believe that only 11.67 lakh rupees, what they've saved right now, will be enough for retirement on an average. And that, I think, was a big, big eye-opener that if this is what you consider sufficient, you're definitely underestimating your total. Though, mind you, I think looking at today's petrol prices, I'm sure everybody has revised that figure upwards. But Kartik, let's talk then about the investment options for retirees and senior citizens. Because at this point, we are also staring at a low interest rate environment. So, but at the same time, of course, you don't want to get too adventurous when you're investing during your silver years, because you don't have a lot of income coming in to supplement any lost money due to these adventurous investments. So what are the options for such individuals?
Every retired person should write this sentence down in their houses or wherever they are sitting. Safety comes at a huge cost. And if last 2-3 years are any sort of indication, we have umpteen examples. We have examples of Yes Bank, DHFL, ILFS, and the list goes on. Safety is a very expensive thing to have these days. So having said that, I'm not saying dump your fixed deposits. Be there. I mean, have a little bit of money into fixed deposits. If you like the senior citizen scheme, that's fine. But you need to open your options to things like PSU debt funds. You need to open options to gilt funds. There is P2P lending, which RBI has sanctioned as a platform. That's as an option there for you. And then you have your traditional options of conservative mutual funds where, you have 15-20% equity, rest in bonds. So that sort of props up the return for you. And look, we have to understand that you can't go away from equities because you're not going to use the money. If you're 60 today, or if you're starting off your retirement, or for that matter, even if you're 70, what happens is there is a chunk of money that you will use 8 years or 10 years down the line. Now, like you mentioned in your report, Mubina, that only 11 lakhs is the amount of money people have because India is a poor country. Because all the time we keep investing in fixed deposits, then how do you expect your wealth to grow and how can you afford to have a lifestyle that you wish, especially in your silver years? So having said that, you're not going to lose all that money in 1 day or 2 days or 5 days. but there needs to be an allocation. And I would actually go 2 steps further, and I would say you should have allocation not only in equity funds, but also in direct equity. Buy some blue chip stocks, hold them for about 8 to 10 years, and then over a period of time, we use a concept of laddering, and I sort of use it in a slightly different way. So what happens is, as you sort of come closer towards it, that time you keep withdrawing chunks from equity and start coming into bonds, maybe 2 years, 3 years, 4 years in advance. So today, for an example, if you're 60, you have a small portion of your money, let's say in equities. So by the time you're 65, 66, 67, maybe you can pick up that money and come back into bonds. So when the time comes to use that money, they are tax efficient, your tax is lower, it's much more controlled, and you have the income stream that you sort of want to have. So I think one needs to open their mind, and I may not want to mince words, it's time to say bye-bye to fixed deposits, because fixed deposits, and if it's a smaller bank especially, or a cooperative bank, or if you're living in some remote part of, in a tier 2 city or tier 3 city, or even a remote part of India, you need to be extremely cautious of the bank that you're banking with. The State Bank of India and the Bank of Baroda's will not sort of, disappoint you ever, nor will the, larger private sector banks. But there are enough banks which will, disappoint you. Punjab, the PMCB Bank, is a live example in front of us, and people are still bruising the, the impact of that kind of a debacle that happened there. So there are lots of things that you need to consider, but please, for God's sake, do not have all your money in the bank. So that's a very dangerous strategy, and that's why safety is a big cost.
Yeah, you're absolutely right. I think with what we've seen happen in the last 2-3 years, it's definitely gotten a lot of people thinking about even the so-called safety of a fixed deposit. If a bank like Yes Bank as well, something can happen to that, then and any which ways for cooperative banks, it's not just PMC. In the past as well, we've seen this issue with cooperative banks. However, of course, the RBI has now brought cooperative banks as well under its ambit. So here's hoping for more monitoring of the activities, which would in turn avoid perhaps, or rather as far as possible, prevent a PMC bank kind of situation happening. And yeah, even though you may consider yourself being safe in a fixed deposit, look at the returns, under 5%, under 6% for a 1-year FD, which barely cuts it, especially when you have inflation floating the way it is. So having all your money in fixed deposits, or even a big chunk of it, does not cut it at all in today's day and age. Kartik, two very commonly used retirement baskets are PFs and ULIPs. And as we sort of progress the ladder, whether corporate-wise or our own business grows, let's stick it towards salaried people, because they are the ones who use EPF. So as we rise in the corporate ladder, obviously our contributions towards these nest eggs as well increase. But now there is a bit of a tweak over there as well. Do you think that would impact someone's investment decision towards PFs, towards ULIPs in a significant manner, or do you think they're still good baskets?
See, I think if we talk about the larger segment of the society, it's okay, because 2.5 lakh is the contribution, which is effectively 12% of an income, and that your basic income has to be somewhere in the range of so something like about 20 lakhs. So it doesn't affect a large majority of Indians per se. So I don't think you need to worry too much about that. But what I have maintained for the last, ever since I have got into this profession of, advising on money matters, I have always maintained, please do not contribute to voluntary provident fund. Provident fund is fine. Whatever is statutory and by law you are supposed to contribute, do that. But then you have other options. Get into SIPs, get into equities, do things that make money for you. In fact, even for the fact that there was benefits available and there are deductions available for NPS. But I tell them that, if you have to do it compulsorily, it's different. But on a voluntary basis, just to save the tax, it's not worth it. Because then that money, even if after you pay the tax, you invest it somewhere else, at the end of 15 years, the multiplier on that money is much larger. And therefore, it's not in your interest to do that. ULIPs, again, if you are in an equity-oriented ULIP, then it's a fabulous idea. In fact, what has happened is since 2018 onwards, a lot of companies came out with ULIPs. They came out with new designs. And in those designs, what they did was, it was meant to actually now become a mitigation against the capital gain tax, because until then, capital gain tax on equity investments was not there, long-term equity capital gain tax. Because that came in, so ULIP suddenly became a very popular product in 2018. And they actually came with a lot of variants for zero cost and zero charges and things like that. And which is why I think this has got plugged into this budget. But again, how many people in India actually invest a 10 lakh premium and a 5 lakh premium per year? Again, this is not for the vast majority of our populace. So therefore, even if you today want to consider a ULIP, you have an you have a deduction up to 2.5 lakhs. You can enjoy 2.5 lakhs paid for 10 years. That's 25 lakhs of corpus over, and over 10, 15, 20 years, it accumulates to a sizable sum. And then the withdrawals that you'll get out of that will be tax-free under 1010D, because you are not crossing the 2.5 lakh limit for premiums. You see, so I don't think that's a bad option at all. But as a retired person, you can't get into a ULIP. Just to clarify that right now, according to me, you should not even get into any annuity product, because as a retired person, it is so much more important that you have access to your funds, you have liquidity. Now, the moment you get into an annuity of an insurance company, they take your money, and then that money will never be available to you, except, in a situation, in an extraordinary situation. But my experience of last so many years is you have to die to get that money, and then it's of course of no use. It goes to your beneficiaries. So you will only get an income stream out of it, which will also be very, very measly sort of an income stream of, anywhere in the range of 4 to 6%. If you're willing to lose your capital, you get higher. But then I don't think any annuity plan is a good idea. If you're young, by all means, do a ULIP. If you're young, by all means, contribute to your provident fund. Do not do voluntary contributions. And use all that cash flow. Your cash flow is so critical. Your cash flow, if it is used in a better format, then in a 15, 20-year period, you will thank yourself for having taken those good decisions earlier in your career. Otherwise, you will end up like most of the 90% Indians who have 10 lakhs, 20 lakhs, 30 lakhs when they retire, and that money seems so tiny when you're 60 and you're staring at 30 lakhs only.
Okay, that makes sense. So if you want to do an annuity, do it earlier. Don't do it when you're retired, because it'll essentially mean locking your money up for some time, and the money invariably is not available to you during your retired years when you actually do need it. Additionally, preferably do not opt for a VPF, a voluntary provident fund. A voluntary contribution doesn't make sense according to Kartik. Kartik, I know you said no FDs, etc., because there's this whole credit factor as well that has come in surprisingly in FDs. But what do you think of all the government-backed schemes? You have the small savings schemes, the entire pack, though there also the interest is a little lower, but still retirees get better options. The other option is the PM Vaya Vandana Yojana. It was discontinued for a little while, then it again resumed. What's your opinion on all of these? Because we get a lot of viewer questions on these too.
Right. I mean, people tend to do that. There's nothing wrong with these schemes. A, it's backed by the government. B, your money is going to be absolutely secure. Your capital is going to be safe. You'll get your payment of interest on time. It's going to be taxable, but that's a different matter. But all in all, it's 6-7%. And today you are seeing, right, I mean, the government is actually not helping you and me at all. The petrol at 100 rupees, and out of the 100 rupees, 70 rupees or 60 rupees, I don't know the exact number, but that's tax. I mean, we pay income tax, we pay GST, we are paying tax and, stamp duties and all these other things. And now there is tax. I mean, there's a humongous amount of tax that we pay in petrol. It's unfortunate, but see, in this kind of a world, if your money is not growing faster, it's not going to help you. So therefore, these schemes are good. Nothing absolutely wrong. Nothing against these, whether it's a provident PPF or a EPF or, these government-backed schemes, postal schemes, everything's great. But it's all a 6-7% story, right? Now, if you want to move to an 8-9% story, what would you do? So you look at gilt funds, you look at PSU bank funds, the debt, the debt funds that invest in PSU banks and PSU company deposits. Again, they are backed by the government. It's a bank, so your money is spread across a lot of banks. Plus, it's traded. So what happens is there is an opportunity for you to make capital gains. So the earnings of interest is still the 5 and 6%, but then the fund manager will try and bring another 2% or 3% to you. It helps you. It adds to your overall kitty. Plus, after 3 years, it becomes tax efficient, right? So you go into the capital gain mode and not the income from other sources in the bank interest mode. So you save a huge amount on taxes there as well. Then gilt funds, they fluctuate. There are years in which it does 10, 12% also. There are years it does about 5, 6%. So the monies that you're going to use in after the next 3 or 4 years, that money can be parked in gilt. So by the time they become tax efficient and by the time they've already made the return. So even if you have 1 or 2 bad years, you're okay. What bad years meaning? It's a low income earning year, or your capital has not grown so much in gilt. But I think gilts is a fabulous idea. I mean, a lot of people don't look at it. But again, look at it. It's backed by the government, central government, zero risk of default, zero credit risk. I mean, what else do you want? Zero entry cost, zero exit cost. It's a great idea. And then, P2P is a scheme which is a very new thing. It's a phenomenon of the last few years. Maybe 10, 15 lakhs can go into P2P and you'll get about 10 to 12%. So that adds to your inflows, right? In terms of your monthly or annual inflows. And then you can also look at, like I said, look at equities as a part of it. So the money or the chunk of money that you're going to earn, or rather you're going to use after 8 or 10 years, that part of the money can still go into blue chip stocks or, funds. But, funds don't really sometimes perform, sometimes they perform. But if you have stocks and blue chip stocks, I don't think you can ever go wrong with some of those. Blue chip category mutual funds are also a great idea. So, you want to protect your risk. Don't go into small cap, mid cap, because they can crash quite dramatically in a bad time. Of course, they make a great amount of money. But otherwise, if you have a little bit, maybe 20%, 30%, it depends on person to person. But you cannot not have money in equities, you see, because that is the one that will give fillip to your returns. And that is the one that will fill your pot in case your pot is running dry and running dry fast.
Okay. Okay, point taken. So yes, government-backed schemes as well, understandable why you'd go for one, and no harm as well, but you'll be in that 6 to 8% bracket, 8 also being a very upper end that I'm talking about. So sometimes gilt funds, banking and PSU funds, equity funds, of course, no doubt, are irreplaceable in many ways. Well, you know what, Kartik, stay on with us. We're going to take a very short break, and when we return, we'll be kickstarting our Ask the Money Show segment, where we'll open our email addresses for you, the viewers. Shoot your email, your questions to us, and we'll get them answered. Our email address is themoneyshow@etnow.tv. Welcome back. You're watching The Money Show on ET Now. It's time for our Ask the Money Show segment. Not much time, but we'll try and squeeze in as many questions as possible. First up, we have Mahindran G, who writes into us saying, I'm 66 years old, have been investing for the last 3 years, beginning in large and mid-cap funds of Axis and Mirae AMC at 20 lakh rupees. So it's a lump sum amount he put in maybe 3 years ago. Or maybe he's made an SIP, it's not exactly clear, but in total his cost is 20 lakhs. He's made a profit of 6.5 lakh rupees. Now he wants to book his profit and put the money in debt or fixed deposits. Understandably, I know where he's coming from, I guess. Debt and FDs do have less volatility, and then again, there's a bit more safety as well. So what do you think, Kartik? Is this a good idea to do?
From a profit booking point of view, yes. From a FD, I'm moving it into a FD, absolute no. See, it's already there in a mutual fund. Why don't you just move the money to a debt fund? Like he's already chosen an option, PSU and PSU debt fund. That's a good idea. Now, having said that, don't sell off everything. That's fine. If he's made 6.5 lakhs profit, I'm assuming that profit has happened at least on a corpus of about 15, 20 lakhs. So it's a decent size of money. So why do you want to get out of it completely? The rally is not over. 15, 20% corrections are normal. It'll happen any point of time. You can't time it. But, maybe half the money, maybe 2/3 the money, but at least have 30, 40% allocation to equity. Like I said, it'll keep the pot boiling. It'll keep adding to your overall net worth. And that money will be priceless when it actually comes to use. So don't sell off everything. Move to debt funds. That's a good idea, or a part of it.
All right. So yes, maybe debt funds, but FDs is a strict no. And yeah, booking profits perhaps is the right thing to do. We have the equity markets as well are at the record high. So yeah, it's a good idea to perhaps book some profits. Of course, not at record anymore. We've seen a bit of correction. Leela Pillai says, I'm a senior citizen and I want to invest 50 lakh rupees each in the PM Vaya Vandana Yojana and the Senior Citizen Savings Scheme. Now I know that, so 7.5 lakh and 7.5 lakh. I know we've largely covered the points around these government-backed schemes, but just for the benefit of Leela and for somebody just tuning in, if somebody has 15 lakh rupees lump sum with them, how would you advise they split it across all the different investment avenues?
Not only for you, but for everyone who's listening to the show, if you have 30 lakhs, you don't just go into 2 products. You have a lot of variety. The range may not be too wide. The range is from 6% to maybe 12%, but that's still a decent range, right? So maybe you can, invest half 7.5 into via Vandana Yojana and 7.5 in senior citizens. That's fine. But the other 15 lakhs, my suggestion is consider doing 5 to 7 lakhs into a P2P lending platform. That's a good idea. It's a very well curated platform. Your money, you're not going to lose money. In fact, you'll be helping a lot of people in the process as well, because you'll be lending directly to them. I think it's a fabulous option to choose. And then invest a part of your money into these gilt funds, because you're not going to use up all the money in one shot. So if you invested about 7 to 8 lakh rupees in a gilt fund, or, let's say 4 options for you: PM via Vandana 7.5, senior citizen 7.5, gilt fund 7.5, and P2P lending platform 7.5. I think that should do a good platform, because you'll be at 6%, you'll be at 7%. And in the P2P lending, you will be at 9 to 10% or even 12%, depending on what you get. And in your gilt funds, there's an opportunity to earn about between 8 to 10%. So you have, spread yourself in different products. And as a result, you'll hopefully get a better, portfolio performance at the end of 5 years.
All right. Okay, well, there you have it. We're not going to be taking any more questions. We've got lots of them, but folks, we'll be here every weekday on 5 p.m. to get them answered. Kartik, lovely chatting with you as always, and thank you so much for joining us on The Money Show.
My pleasure. Thank you.
All right, well, we'll do one thing. We'll slip into a very short break right here on the show, but be right back.